Have you ever considered what happens when a centuries-old financial institution finally loses its authority? Not because it goes bankrupt or shuts its doors, but because it loses the one thing that made it powerful in the first place: credibility, the ability to set the price that the entire world accepts as legitimate. The legendary London Bullion Market Association, the LBMA, just witnessed its authority shatter in real time. And the fracture didn't come from regulators or political intervention. It came from a single number, a number that appeared on trading screens in Shanghai that should be impossible if London still controlled the global price of silver: $99 per ounce. The Shanghai Futures Exchange just printed $99 silver, $1 away from triple digits. $1 away from a psychological barrier that will force a complete reassessment of every assumption we have about silver markets. And while the West celebrates new highs in the $88 range, while analysts debate whether resistance will hold at $90, Asia just positioned itself at the threshold of $100. This isn't just a bull market anymore. This isn't just momentum or safe haven demand. This is a structural break, a regime change. The moment the world realizes that the price you see on Western screens and the price you actually pay to secure physical metal have become two completely different things. And the gap between them, a spread that should be impossible, just hit $11 as Asia tests the century mark. Welcome to the new reality. Before we go any further, welcome to our channel. And a quick disclaimer, because this is important: this is not financial advice. This is market analysis documenting a historic event. I'm not telling you to buy or sell anything. Always do your own research and consult with qualified professionals before making any investment decisions. What I am going to do is walk you through what just happened, explain why Shanghai printing $99 silver represents the death of London's pricing authority, and show you why this number changes everything about how silver markets will function from now on. Let me state the situation plainly, because the implications are staggering. The Shanghai Futures Exchange, or SHFE, just printed $99 per ounce. That's not an estimate or a projection. That is the actual clearing price in the physical-oriented futures market that serves Asian industrial demand. $1 below triple digits. Meanwhile, silver in Western markets has been trading around $88. Let's be conservative and call it 88. That creates an $11 spread. 11 full dollars between what Asia pays for physical settlement and what Western paper markets claim silver is worth. In a functioning global market, an $11 spread should vanish instantly. It should be impossible to sustain. The fact that Shanghai can print 99 while the West trades at 88, the fact that this spread is widening, tells you one thing with absolute certainty: the bridge is broken. The mechanism that kept global silver prices unified has failed, and London's authority to set the global reference price just died. Most people track silver like it's a stock. They stare at charts, watch technical indicators, and argue about resistance levels. They treat it like a game where Western futures markets determine the price. But what just happened in Shanghai proves that assumption is dead. Price discovery isn't a chart pattern, it's a system. A mechanism where buyers and sellers meet, and actual metal changes hands. And systems fail when they stop converting promises into performance. In metals markets, performance means two things: liquidity and deliverability. The ability to trade and the ability to turn that paper position into physical metal. The reason Shanghai printing $99 is the death knell for London's authority is simple. Asia just proved it is willing to pay $11 more per ounce than Western benchmarks suggest is necessary. It proved that when you actually need the metal, the London price is irrelevant. And it proved that Asia is now driving price discovery toward triple digits while the West watches from $11 below. Let's quickly cover what the LBMA actually is. It's not a single exchange like COMEX. It's an over-the-counter network centered in London. It's built on standardized good delivery bars, clearing banks, and a massive system of unallocated trading where people hold claims on pooled metal instead of specific bars. For decades, this London system set the global spot price. That system worked because everyone assumed if you wanted metal, you could get it without the price exploding. Shanghai just proved that assumption is dead. When Asia pays $99 for physical settlement while London's system suggests 88 is the price, the message is unambiguous. The London reference price no longer reflects physical reality. It doesn't capture what metal actually costs when you need guaranteed delivery. Goldman Sachs recently described the situation diplomatically, saying silver is stuck in the wrong places. That was when the spread was $5 or $6. Now, with Shanghai at 99, that language is inadequate. The metal isn't just stuck. It's being repriced by a market that London no longer controls. And that repricing is driving toward triple digits, regardless of what Western benchmarks suggest. Let me be precise about what I mean when I say London's authority just died. I'm not claiming the LBMA shuts down tomorrow. I'm describing a collapse of price authority, the loss of power to set the global reference price, A market can still exist and facilitate trades, but lose the power to determine what the commodity is actually worth. That's what happens when the number on your screen diverges so dramatically from the price people pay in the physical world. When Shanghai prints $99, when industrial buyers validate that price with real transactions, while the West lags $11 behind, London's $88 price becomes a historical artifact. It's a number that represents where Western paper derivatives think silver should trade, disconnected from where physical metal actually clears. The LBMA has been updating its governance and rules, which is normal. But rules only matter if participants trust the system and believe the reference price reflects reality. Shanghai printing $99 while London shows 88 destroys that trust instantly. The game has changed. The world's largest physical market is now leading the charge, and it's pointing directly at $100. The old rules, the old authorities, and the old prices are being left behind. This is a monumental shift, and we are witnessing it unfold in real time. Every procurement officer, every industrial buyer, every entity that needs actual metal instead of just paper exposure now looks at the London price and knows it's fiction. They know if they tried to source significant quantities at $88, they'd discover the metal isn't available. They'd discover delivery times stretching out. They'd discover that premiums over the spot price make the real cost much, much higher. They would discover that the only reliable clearing price is what Asia pays, and Asia is paying $99, testing triple digits, and driving toward a barrier that will change everything. In a healthy, integrated global commodity market, the spreads between regional hubs are boring. They're measured in pennies, maybe $1 at most, and they close quickly as arbitrage kicks in, as metal flows from cheap regions to expensive ones. But when spreads hit $11, when they reach levels where one region pays $99 while another claims 88 is fair value, the market is screaming that normal mechanisms have failed. Metal is not flowing efficiently, arbitrage is not functioning, physical constraints are binding. The paper reference has detached from physical reality so completely that one market is approaching triple digits, while the other is stuck in the high 80s. And Asia isn't just another region with local preferences. Asia is the center of industrial silver demand, the center of refining that turns ore into bars, the center of fabrication that turns metal into components. And critically, Asia's exchanges lean toward a physical settlement culture. That's why Shanghai becomes the truth serum when stress hits. When paper and physical diverge, Asia reveals what metal actually costs. And right now, Asia is revealing that silver costs $99, just $1 from a psychological barrier that will force a complete market reassessment. Let's ground this in the numbers that just appeared on screens. The Shanghai Futures Exchange, or SHFE, posts prices in renminbi per kilogram. When SHFE prints the yuan equivalent of $99 per troy ounce, that's not some theoretical conversion. That is the actual clearing price for contracts that settle physically, that deliver actual metal, and that serve industrial buyers who need a guaranteed supply. $99, $1 below the round number that matters. $1 from the level where three-digit pricing becomes a reality. Meanwhile, Western benchmarks have been printing in the $88 range. The exact Western number matters less than the spread and the trajectory. Because whether the West is at $87, $88, or even $90, Shanghai at $99 creates a gap of $9 to $11. And more importantly, Shanghai is driving toward $100 while the West remains materially lower. That's not regional variance. That's not a time zone difference. That is a structural fracture, with Asia leading price discovery toward triple digits. If Shanghai clears physical metal at $99 while Western paper trades at $88, you have two completely different products sharing the same name. One is derivative exposure, providing price participation without requiring physical delivery. The other is the physical access price, reflecting what industrial users must pay to secure a guaranteed supply and reflecting where the market is actually headed. $11 of difference. The textbook says that gap should close immediately through arbitrage. Buy cheap in the West at 88, sell expensive in Asia at 99, move the metal, and capture $11 per ounce. It sounds like free money, an obvious opportunity. So why isn't it closing? Why isn't every trading desk on Earth executing that arbitrage? Why can Shanghai sustain $99, testing triple digits, when the West offers 88? Because arbitrage has prerequisites that theory ignores. To arbitrage physical silver at scale, you need three things simultaneously. First, available metal in the cheap market. Not just inventory on spreadsheets, but metal that's actually for sale at that price. Second, you need the logistics, financing and insurance to move it. Freight capacity, secure transport, customs clearance, export licenses. And third, you need clear delivery specifications and timelines into the expensive hub. Metal that meets Shanghai's requirements, arriving when buyers need it. When any of those conditions fails, arbitrage breaks. The spread stops representing opportunity and starts representing reality. It represents that metal genuinely costs $99 in markets that require physical delivery and only costs $88 in markets that settle financially. It represents that the market is driving toward triple digits in regions where physical matters, while remaining stuck in the 80s where paper dominates. Goldman's old phrase, "silver stuck in the wrong places," described this arbitrage failure. But now that Shanghai hit 99, now that Asia is testing the century mark while the West lags $11 behind, that description is inadequate. The metal isn't stuck. The metal is being allocated to whoever pays the real price, and the real price just tested triple digits. Here's the avalanche dynamic that Shanghai hitting $99 accelerates. A premium emerges in Asia, that's already happened. Western inventory tries to flow east, that's already happening. London's local liquidity tightens, it's already tight. The benchmark becomes more volatile and less trustworthy. That's happening now as the spread widens. More participants begin to price off physical hubs instead of London. This is the critical stage we are now entering. And finally, the benchmark loses its authority completely. This is what Shanghai at $99 confirms. You don't need an official default for this progression. You only need the market to demonstrate through actual clearing prices that London's reference is irrelevant and that price discovery has migrated to Asia, where triple digits are being tested. Shanghai just did that. In a physical squeeze, arbitrage becomes self-defeating. Watch what happens. You see the spread, West at 88, Shanghai at 99. You decide to arbitrage. You buy Western exposure and stand for delivery. But doing so drains Western inventory even further. It makes the local market tighter. You transport the metal to Shanghai, which takes weeks. By the time you arrive, Shanghai has repriced again. Maybe now at bar S broken through 100 and is trading at 102 or $105 because the shortage intensified and the psychological barrier was crossed. Your arbitrage attempt didn't close the spread. It proved the spread reflects genuine scarcity and proved that Asia is driving price discovery toward levels the West, CA, and imagine. That's why Shanghai printing $99 is such a powerful signal. It matters more than any Western technical level. When price discovery migrates east in a strategic commodity, when Asia sets the clearing price for an industrial input that Western economies also depend on, it signals something broader than just silver market dynamics. It signals the fragmentation of global trade. The assumption that commodity markets are unified, that arbitrage keeps everything connected, is dead. It signals jurisdiction risk, that metal in one region can't move to another due to regulatory barriers or political friction. It signals reserve strategies shifting toward hard collateral, with major economies reconsidering what assets they hold. This is why gold and silver thrive when confidence in institutions wobbles and trust in currency erodes. And now with Shanghai at $99, with the spread at $11, with London's authority shattered, you get the complete picture. The West prints references, numbers on screens, derivative prices stuck in the 80s. The East clears reality, actual metal changing hands, physical settlement occurring, and price discovery driving toward triple digits. I'm not going to tell you what to buy. I'm going to tell you what matters now that Shanghai has reached $99 and is testing the century mark. First, this $11 spread cannot compress easily. Western benchmarks must chase toward $99 and beyond, or the split becomes permanent. Second, $99 is the threshold. $1 from triple digits, the psychological barrier that changes everything. Breaking through 100 will force a complete reassessment of assumptions and validate the squeeze thesis. Third, Asia is now driving price discovery. Shanghai at 99 proves that physical markets, not paper derivatives, are determining where silver is headed. Fourth, industrial buyers now have confirmation that securing supply requires paying Asia's price. They can't rely on a benchmark that's $11 too low. Fifth, the next move is obvious. Shanghai at 99 means 100 is imminent. Once that barrier breaks, the West must either chase aggressively or admit complete disconnection from physical reality. And sixth, Western institutions face a crisis. If they've been pricing risk and valuing portfolios based on London benchmarks at $88, and the real clearing price is 99, testing 100, their models are wrong by more than 10%. Their risk management is wrong. Their valuations are wrong. The market is speaking, and it's speaking from Shanghai. Forget everything you thought you knew about the silver market. The old rules, the old frameworks, they're obsolete. The game has changed, and if you're still watching the same old signals, you're looking in the wrong direction. There's only one thing that matters right now: the spread, the gap between the price in the West and the price in the East. Right now, Shanghai is printing $99 silver. Let that sink in. $99. Meanwhile, Western paper markets are stuck at 88. That's an $11 gap, an impossible gap. This isn't just a discrepancy, it's a structural break. It proves that London has lost control. It proves that price discovery, the very heart of the market, has migrated east. So what should you be watching? Not the talking heads on financial news. You need to watch the signals that tell you what's really happening. First, that spread. Does it compress as Western markets wake up and chase Shanghai towards the century mark? Or does it widen even further as Shanghai smashes through $100 and begins repricing silver to 102, 105, or even higher? The century mark itself is the next critical signal. When does Shanghai break $100? Is it hours away? Days? And when it happens, does the West follow immediately? Or does this great split, this bifurcation, accelerate? The answer to that question will define the next phase of this market. Then, watch physical premiums around the globe. If you see dealers everywhere start charging massive premiums over the Western spot price, that's your validation. It confirms that Shanghai's price is the real price. It tells you the drive toward triple digits is not speculation. It's a reality being priced in by people trading actual metal. Pay attention to delivery timelines. Are delays for physical silver extending from weeks into months? Are dealers suddenly stopping new orders? Are we seeing allocation systems pop up where you can only buy a limited amount? These aren't just logistical hiccups. They are symptoms of a severe physical shortage, and they explain exactly why Asia is testing $100 while the West languishes behind. Keep an eye on the exchanges themselves. Are they hiking margins? Changing the rules of the game? Offering flexibility in settlements, which is just a fancy way of saying they might not be able to deliver the metal? Any of these interventions is a distress signal. It's the system screaming under the pressure of a physical squeeze. And finally, watch for policy actions. Export restrictions, announcements about strategic reserves, any government getting involved. The moment this becomes a political chess match, the move toward triple-digit silver accelerates dramatically. This is no longer just a market story. It becomes a national security story. If these signals stay tight, if Western paper refuses to chase Shanghai's lead, and if this price gap persists as Asia breaks the $100 barrier, then triple digits become the new floor, not the ceiling. Think about it. If Asia demonstrates it's willing to clear physical transactions at 99, if Shanghai breaks 100, and if industrial demand supports these prices, the market has no choice. It must reprice. It must force Western benchmarks higher to reflect physical reality. It must admit that triple-digit silver isn't a wild fantasy. It's an observable fact in the markets that actually move metal. What we are witnessing is not speculation anymore. It's not some bullish forecast. This is an observable fact approaching its inevitable conclusion. Shanghai printed 99. The West is at 88. That $11 gap is the proof. It's the evidence that London's authority has collapsed. And it proves that triple-digit silver, once dismissed as a fantasy, is about to become reality in Asia, while the West scrambles to either catch up or admit its own complete irrelevance. Today, right now, you aren't just early in a bull market. You're witnessing a historic structural transition at its most critical inflection point. This is the moment a centuries-old pricing authority dies. The moment physical reality overwhelms paper promises. The moment Asia takes control of price discovery for a strategic commodity and drives it toward a psychological barrier the West thought was years away. So let's be crystal clear about the takeaway here. London isn't dead in the sense that its lights are off. London is dead in the sense that it has lost its authority at the exact moment that matters most. When Shanghai is testing $100 silver and London's system shows 88, its price becomes meaningless. It's a reference to a world that no longer exists. Western benchmarks now face a binary choice. Either they chase Shanghai toward 99 and prepare for the breakthrough 100, admitting they were wrong and repricing dramatically higher. Or they maintain their current levels and become completely disconnected from physical reality, trading as a pure derivative with no relationship to the cost of actual metal. Either way, London's century of pricing authority just ended. The regime has shifted. The institution that set global silver prices for generations just lost that power, not through regulation or scandal, but through pure market forces. We don't have to guess what happens next. We know. Shanghai at 99 means 100 is imminent. Triple digits are being tested right now. The barrier is about to break. And when it does, when Asia confirms 3-digit silver through sustained trading, the West must follow or admit permanent irrelevance. It must chase the price or become a historical footnote. This is why we're tracking this historic transition in real time, session by session. Because Shanghai printing $99 silver isn't just another day in the markets. It's the day price discovery officially migrated from west to east. The day the world learned that physical reality always trumps paper promises. And the day triple-digit silver stopped being a fantasy and became an imminent reality. The alarm is sounding at maximum volume. $99 in Asia, 88 in the West. An $11 spread that screams that the system is broken. Authority is collapsing in real time. Triple digits are on the doorstep. The only question is whether you're listening, whether you understand that everything you knew about this market just changed, London's silver market didn't collapse gradually. It collapsed the moment Shanghai hit 99 and the West couldn't follow. Stay close, track the spread, watch for the breakthrough 100. We are witnessing history, the transition from paper authority to physical reality, from Western control to Eastern clearing. The bridge is broken, the spread is $11. Shanghai is at the gates of 100. And London's century of authority just ended. Thanks for watching. Make sure to subscribe so you don't miss our updates as this story unfolds.